You mentioned briefly there the process when it comes to valuation, and I've read before that some of the discounted cash flow analysis, the DCFs that you do, often the length of these forecasts are quite, well, I'm going to say they're a lot longer than I've seen before done in practice. And then that obviously brings in interest rate risk and how you think about that in terms of your valuations and your modelling. So perhaps you can guide us through your valuation process or what your analysts would do, and then where you think or how you think that impacts valuations more broadly, but also for you here at Magellan.
Yeah, well, we've obviously got a large analytical team. We've got about 30 analysts at Magellan, and they don't cover a lot of stocks. An analyst may cover 5 to 8 stocks only in what they do, and they build very, very detailed financial models, and it's all done under a very consistent framework and modelling that we do. And the analysts do all their own earnings projections. We obviously do a lot of sensitivity analysis on that in terms of the valuation. But the interest rate is, and I must admit, I don't personally need, I look at the value and I go through all the assumptions, but for a very, very good business, I can pretty much calculate the DCF in my head.
Yeah.
I don't need a very detailed financial model if I understand the economics and what on average the growth profile of that business. That's a really hard thing. Trying to predict what the coupons are going to be from an equity bond, that's the hardest thing. And they're actually more predictable in really high quality businesses than they're in low quality businesses. And when this topic on interest rates, and the reason why I could predict something in my head, because I understand the mathematical relationship. So let's say we have a business and we have the old world where risk-free rates were 5% per annum. You add the market risk premium of 5%, and let's say the discount rate you're going to use is about 10% per annum. That if you had a business that could grow in perpetuity at 4% per annum, that business would be worth a multiple of its free cash flow on a DCF basis of effectively 16.7 times its free cash flow. And if it was at a 5% growth rate in perpetuity, it would be worth 20 times free cash flow there. But now let's say that interest rates change. Okay, so we're still at a business, exactly the same business, something we've predicted, and let's say we thought Coca-Cola for the next 20 years could grow at 4% per annum. Okay, and that's the judgment call we make in understanding the business, and the free cash flow gets closer to its profit after tax, the higher return on incremental capital is, because it needs less capital to grow, and that's why we like those businesses, because the starting point of free cash flow is higher. So let's now say that long-term risk-free rates of 4%, not 5%. That exactly the same business, instead of being worth 16.6 times free cash flow, would now be worth 20 times free cash flow. And if risk-free rates are going to be 3%, suddenly that multiple becomes 25 times. And if risk-free rates are 2%, that same multiple is going to be 30 times. So depending on the interest rate environment you're in, we could value exactly the same business between 16.6 and 30 times free cash flow. And so that's a very, very important issue and a judgment call for us to be making. I can tell you if rates are going back to 5%, these markets are overvalued. And if they're headed towards 2 to 3%, these markets are still undervalued. And it's a very interesting issue that if you can find businesses that can grow as rates come down, and a business could maybe grow at 5 or 6%, you start approaching something called the Petersburg paradox, where when the perpetual growth rate starts approaching the discount rate, you start mathematically heading towards infinity in terms of valuation of these businesses. So from a macro point of view, we're trying to do things. We're trying to understand what interest rate world we're going in, and we think it's structurally lower than it was in the past. And then we're trying to find long-term structural growth. If we can find long-term structural growth for the next 20 years of 6% a year, it is ridiculously valuable in this world of interest rates are coming down. And so that's how we kind of feed the macro. Our analysts are there to try and predict the coupons.
Yep.
The macro side is trying to value what those coupons are worth, ultimately, either to help find areas of demographics or something else that could drive a structural growth story and therefore look at the hunting ground, but also the interest rate side is a very, very profound and deep macroeconomic equation that no one knows the answer to, by the way, and we of course, we run ranges around that.
For sure. So you don't use, say, a standard discount rate across all companies that you value. I suppose it's determined in part by the strength of the franchise.
Well, we're using a classic CAPM type equation. We'll use a standard risk-free rate that we're making assumption. But, you've got risk-free rates of negative in Europe and Japan at the moment, and you're at less than 2% in the United States. We are not using those risk-free rates in our valuation models, but nor are we using 5% anymore. So let's say we're running somewhere between 2 and 5. I don't want to say exactly what we're running, and we run a range there. So we standardise that, and we standardise when you have to fade down to your cost of capital and things. So there's standard models that get run, but it's then up to the analysts to determine what the free cash flow is going to be.